We have with us Mr. Bruce Flatt, who's the CEO, Brookfield Asset Management, and it'll be very, very pertinent to gather his insights with regard to this very important conversation and understanding in terms of the fact that if the playbook has really, really changed. While we do have Mr. Flatt joining us to share his thoughts, let me again tell you that this conversation will be spearheaded by Bodhisatva Ganguli again. And as we know that Mr. Bruce, who's the CEO of Brookfield Asset Management, is also the leading global alternative asset manager with approximately $650 billion in assets under management. And that's the reason I think it's important to gather his expertise in terms of understanding around this entire playbook. And once again, Bodhisatva Ganguli, the executive editor, the Economic Times, will be spearheading this particular conversation for us all. So let's find out the answer to this question with this conversation.
Thank you so much. Let me also take this opportunity to welcome Mr. Flatt for the digital edition of the GBS. This is an event as many of you know, we've been holding in Delhi since 2015. The last couple of editions have been digital, but as has always been the case with GBS, we have a stellar lineup, a stellar cast. So thank you so much. Hopefully the next one will be a physical one, but we'll see how that goes. Let me begin, since we have the CEO of the worldwide CEO of Brookfield with us. Let's ask with a few. We'll come to India, but let's ask with a few global questions to him. Mr. Flatt, the U.S. Fed has obviously begun a process of monetary tightening. They're going to raise interest rates a number of times in the course of the year. And there is some concern about a recurrence of taper tantrums and outflow from the emerging markets such as India. There's also obviously been the recent events in the Ukraine, which has led to a fall in markets worldwide. How do you think India will be impacted by these developments, and to what extent do these developments impact an investor such as Brookfield?
So thank you for having me, and it's great to be here. And look, I would just first, and maybe I'd step back from that question and just put everything into context. Interest rates were zero, and they were taken to zero, and they've been there for 2 years, in essence, in the United States and almost globally. And therefore, even if we see, and on the other day I saw 10, but 8 or 6, 25 basis point increases, we're talking a short rate in the United States of 1 3/4, 1.5%, 2%, maybe 2 1/4. These are incredibly low rates in an economy. So yes, the Federal Reserve is going to increase interest rates. They must increase interest rates, and it is going to happen. So the real question is, but despite that, rates are going to still be extremely low globally for alternative investors. And yes, there are some things in some places where people will lose money. And stock markets are adjusting today globally to that, and that's changing some of the markets globally. And all of that is natural, and in fact, it's a good thing, because stock markets were probably too high in some spots. There was a dispersion between value and growth stocks. Now, what that means is globally, as interest rates go up, though, people are buying bonds. If they can earn 2 3/4 on the long end, buying a long end treasury, and they don't think they're going to lose any more money, capital will flow from emerging markets. So it is disruptive to flows, but I think what we should keep into perspective is, despite short-term changes or aberrations, in the long term, interest rates are going to be extremely low, which means that where you can get term premium or where you can get excess premium from emerging markets, money is still going to flow.
So one of the mistakes which some analysts think that the US Fed might make in the whole process is that they might tighten too fast and they might tighten too much. What are your views on that?
Look, I'm not a macroeconomist, but the United States and most central banks in the world have an incredible group of macroeconomic individuals who are very skilled. And this is not a place where they haven't been before. So they have lots of history to look at, and I think they'll make the right decisions looking forward.
So obviously the whole problem comes from the fact that inflation, at least in the Western world, is at a kind of 40-year high. I mean, since the early 80s, since the Volcker crushed inflation, the West has probably not seen inflation in the range of in the 6-7% kind of a range. There's been this long-standing debate between team transitory and team not so transitory. I know you said you're not a macroeconomist, but what are your views? Do you think it is a temporary supply chain shock caused by the events of the last 2 years, by people buying, more goods compared to services, or do you think this is a start of a longer trend?
Look, I think that people often want to put ideas or concepts into groups, and there often are 50 shades of what it can be. And there's no doubt what we're in today is that the economic engine of the world was shut down. And that has caused major changes in supply chain, employment of people, moving goods around the world, and all of those things. And when things just shut down, it's very difficult to get them started. And because of that, we're seeing an enormous amount of supply chain issues, not demand issues, which are often the case, but supply chain issues. So I would say transitory often to people means 3 or 6 months. This is a transition back to a normal economy. And it's going to take us a little bit of time to do that. But we don't believe we're going back to the inflation of the 70s or even anything remotely close to it.
How does an event such as what's happening in Ukraine, possible wide-ranging sanctions on Russia, how does that add to the mix?
Look, these type of political events cause uncertainty in the markets and people wanting to go to more certain securities. So you're going to see U.S. Treasuries, more purchases of U.S. Treasuries. You're going to see more purchases of things that are in that direction with less risk. But in the fullness of time, the thing I would just say is that every so often, and it seems more often than so often, but there are shocks to the world, whether it's a pandemic, a war, economic collapse, recession, or you name it, but we get through it. And we always do. And yes, there'll be some consternation along the way with events like are happening with Ukraine. But in the fullness of time, I think we'll all work through it.
So let me just come to one of your obviously Brookfield is in fact it's along with actually Blackstone is a very large landlord in India. I'm not quite sure. I think Blackstone is maybe slightly larger in India, but you are. Given what has happened during the pandemic, the work from home, which has now gone on for 2 years, what is your view on the outlook for commercial real estate?
So there are many types of commercial real estate, of course. I think what you're referring to is office, office real estate. And I would just say that globally, we have a very large office portfolio, and what we're seeing today is that either companies are back in the offices, or they're shortly going to be back in the offices, or have plans to be back in the offices. And with COVID waning around the world, the reoccupation of offices continues to increase almost every week. And there's no. That maybe the more important thing is when we're talking to global CEOs, they have no plans today of running a workforce from remote locations. Now, it's possible they'll give more flexibility. It's possible they'll operate their offices or build out offices a little bit different. But bottom line, most things are going back to similar to what they were before.
Let me come to a sort of an India-specific question. There has been a certain amount of decoupling due to geopolitical reasons between China and the US. There are perhaps two separate supply chains being built up. And most MNCs have a China plus one strategy. Now, India would like to be the plus one, or like to be the main sort of, first among equals when it comes to the possible potential plus ones. I mean, you have Vietnam and Philippines and so on and so forth. What is your view on India's prospects in that regard, as emerging as a rival to China in a wide range of industries?
Look, India is an incredibly attractive place to invest. We've been very lucky over the last decade of our involvement in India in a major way, and India has many advantages. The English language being a really important one for global companies, rule of law, and really a workforce that is entrepreneurial and can supply employment. So I think India has a number of great advantages, and I encourage everyone that's an influencer that's listening to this to take advantage of it during these times, because I think you will continue to build out the country in a great fashion.
Right. So, private equity deal making reached historic heights in 2021. PE funds are set to be sitting on estimated 2.3 trillion, of deployable funds. Now, do you anticipate that the robust PE and M&A activity will continue in 2022, or will some of the issues that we discussed, such as supply chain, inflation, potentially higher interest rates, will that make it more difficult for the PE firms, for the alternative investment?
Look, probably the most important thing for private equity groups to put money to work is to A, raise the money, and B, put it to work in a proper fashion. And what is troublesome is when you can raise a lot of money and valuations are high and you put it to work at that point in time. But given that there's significant cash raised and valuations have been coming in just because stock markets are down and there's more disruption in the world, that's a great opportunity to put money to work. And odds favor, if you enter at the right point on investments, that you should do better in the fullness of time. So I think it's I believe that there'll be some great opportunities. Now, there may be some sectors where that doesn't play out, but there will be many things that at this point in time, returns will be higher in the longer term than you would have otherwise found, because you're taking businesses private or otherwise at lower multiples.
Right. You so far you've not been a major. You've invested, obviously. You own pipelines in India. You own the tower business of Reliance Jio. You obviously have a big real estate portfolio. You've so far not put any money into the Indian startup ecosystem, or what is referred to as the startup ecosystems. The food delivery companies, Swiggy and Zomato, and those kind of things. Is there anything in the works? Is that a sector which you would potentially look at going ahead?
So our growth investing business revolves around the $650 billion of assets that we have globally. So when we find a product that we can influence with our economy of businesses, we invest in it through our growth funds. And to date, we haven't done investments in India, but we have a large team in India. And when we come across some opportunities, we'd love to be able to put money to work. So and help entrepreneurs in their businesses. And so I suspect in the next few years, we'll find some opportunities to do that, and we're excited about it.
You've closed a number of major deals in the last few years, the pipeline deal, the deal with Reliance Jio, and so on. And I think the total amount is about 20 billion, if I'm not mistaken. What would what kind of investment, could we see the fund committing in India over, let's say, the next 3 to 5 years?
Look, we generally don't. We have $100 billion of capital today to invest into opportunities. There's no fund investment we have that will probably put more than 20% in India. But we don't have any targets as to what we should invest in. What we look at is where there are great businesses that we can buy for a reasonable price and compound returns over very long periods of time. And to the extent that those opportunities come to us in India, we'll keep investing in things, because so far we've been very well treated with all of our investments in India, and I expect that to be so going forward.
Okay, you partially answered, because my next question is going to be that you've invested in real estate and infrastructure areas which are, considered tough in India due to various reasons. But you're saying you've had a good experience so far.
Yeah, look, I don't think we've had any. When you ask a question like that, you have to reflect back over 15 years. But look,
Right.
all I would say is our playbook is to go to a country, learn the market, introduce ourselves to the entrepreneurs, meet the banks, become a local player, and invest in opportunities when there's less capital than otherwise in the marketplace. And I would say India, the one thing that it lacks generally is large amounts of foreign capital to do substantial things. And that's allowed us to be able to put significant amounts of money to work in India. Everything that we've done, we've been well treated. And therefore, we're going to keep building out our business.
Right. I mean, the closing the tower deal with Jio did take quite a lot of time, though.
Look, the answer is yes, but I would say it was a large transaction that has regulatory issues, and in the end, we did get approved. That happens in every country in the world that we operate. So one should not think that India is the only one that has some regulatory issues in it. I can tell you in the United States or Canada or the UK or other places, we have similar issues of getting approvals. And we're among we tend to think of the highest quality investors, but it just takes time sometimes. And we're patient investors for long periods of time. And I think that if one operates in a good fashion, India will be a great place to invest.
So one of the Modi government's one of their sort of flagships program is to improve the ease of doing business and to move up the World Bank's rankings. The World Bank, of course, has recently scrapped the ranking, but that's a different matter. So given that you've dealt in a number of sectors in India, considered not so easy over a period of time, would you say that it is becoming easier and there is greater certainty, the usual things that investors look for? There's greater regulatory certainty in India. Are things getting better over a period of time compared to what it was some years ago?
Look, what's important for a global investor, because as opposed to an Indian investor, you generally have capital in the country, or that's your expertise, and therefore you invest there. We invest in 30 major countries around the world. And we don't have to invest in any one country, and we don't need to stay there. We try to pick countries that are large enough that they can be meaningful to us, have a good respect for capital, that we can operate with the standards that we must operate with from a global perspective and with our institutional clients, and that we can be in for the longer term. And while capital markets go up and down, we can invest and continue to own businesses. And I would say India has met all of those things and gotten better and easier over time for us to operate in. Now, it's possible it's gotten easier because we're more experienced and our people are better and we understand the country more, and therefore we can fit into the system. It's possible it's that. It seems like it's gotten better. I think it has. And the government has tried to open up and streamline, and I think they're doing a good job at it. Now, with regulation, nobody's ever happy. They always want easier regulation, but we've been able to get things done across the country.
Are there, I mean, given that, are there any exits from India which are likely in the near future? Any sort of bumper exits or otherwise?
Yeah, look, our business is about earning good IRRs, but very high multiples of capital, meaning we often buy things and hold them for much longer periods of time from people because we tend to be operators in the business. We tend to think longer term and tend to stay longer. So these are in very long-term funds or on our permanent capital balance sheets, and therefore we don't really have to exit. And when you can find phenomenal investments for long periods of time, generally it's better not to make exits in the short term.
Right. Okay. As far as just to come back to a question which I asked earlier in a different form, I suppose Blackstone started as a traditional PE firm and then went into real estate in a big way. You've started with real estate and have become much more of a, I mean, it's real estate plus PE. What about internet-enabled consumer companies? How do you look at that sector kind of worldwide?
Look, I'd say the one comment I would make is that technology in 10 years from now won't exist as an asset class. People think of technology as an asset class, but what's happening is that technology is just integrating into all businesses in the world. And therefore, a greater focus of ours in almost every business that we're in is on businesses that are benefiting from technology, and software is becoming a new infrastructure. But the businesses that embrace technology, even in old line businesses, are becoming the winners. So we're very laser focused on it. And it's important for our investing across the board, not just in our growth and venture businesses.
Right. One question on, ESG is obviously emerging as a dominant theme for in business in general. How important is it to Brookfield?
We've always had a large focus on all of E, S, and G. Governance is obviously extremely important to us because of the relationships we have with global sovereign institutional clients. Sustainability is important in every business because if you don't operate with good global standards, it just causes you issues over the longer term. And as a long-term investor, we need to make sure we consider that. And on the environment side, we've committed very substantially to net zero carbon emissions. We just raised a $15 billion fund to not for our own businesses, but to assist other corporations decarbonize. And we've been putting money to work, both building renewables out, but also providing money to industrials and power companies to help them decarbonize. And we think that'll be a very significant business going forward.
But on that note, I think we're out of time. So thank you so much. I think we've covered an exhaustive gamut of topics, and thanks for giving us your time, and hope to see you physically perhaps a year from now. Thank you so much.
Thank you, Bodhi.
Thank you.